Okay, so this segment is uh, establishing the assumptions for property, plant, and equipment, and its attendant depreciation. Right. So if you look at the latest financials, which is that of 2021, and you do a search, Control F for property, then property should bring it out. Um, okay, so we've got information relating to property under director's reports. Information relating to changes in PPE is disclosed in note 15 to the financial statement. In the opinion of the director, the market value of the company's PPE is not less than the carrying value shown. So that's giving us an insight that there is no impairment on their property, plant, and equipment by saying that the market value is not lower than the carrying amount. All right, so we continue next. Next. Okay, so we've got to the statement of financial position, which is the balance sheet. So you see the property, plant, and equipment disclosed for 2021. So I'm going to concentrate on 2021, particularly for the existing assets. So this is the carrying amount, or what we call the net book value. So this is what we have in our model as this. So the net book value for the assets is 98 million 964,157, so which is what we have here. But we need to go into note 15A to actually see the breakdown of these assets, and also looking at the right of use asset. These are the two assets we have. That's the asset on lease. So we have 4,848,732. So we move. So the notes to actually check is 15A and 15B. All right. So our statement of cash flow will show us the depreciation that was written back. So this is the depreciation that was written back, and it is composed of that of plants and right of use assets. So this is what will show up in our P&L account, 8,493,995. So if you check our P&L, depreciation 2021, 8,493,995. So that's exactly what they charged in the P&L during the year. So they are writing it back here, you know. Okay, so but also note that that's for equipment and property, plant and equipment and right of use assets. Okay, so maybe that might need you specifying that here, and right of use assets. Okay, so that we know that that's a combination of the two. Okay, so we'll continue to do a search on PPE. So we had the loss on property, plant, and equipment of this figure. So the norm is for modelers, it's difficult to actually establish the trend on a loss on disposal of PPE, because companies are not set up to sell their assets, and so it's actually very difficult to determine which asset is to be sold. You cannot actually pin it down that a proportion of the company asset will be sold, except if there is a trend that has been established over the past years. But what I see from experience on sales on property, plant, and equipment is that it fluctuates. In the past years, it might be maybe in 2017, it might be 20,000. In 2018, it might go to 5 million. So you see that, then you see it fluctuating drastically, a wide variations between them. So that sends a signal that it's an item that is difficult to actually place a forecast on, So that's why I, I mean, personally do not actually consider it during forecasting. And because companies are not set up to continue to sell their assets, so it is key for analysts to actually concentrate on items that will occur year on year, items that have as that have trends over time, and the trends are not, they don't have wide variations. So an item like this cannot actually be pinned down. But I've seen models where modelers place a very low percentage. They peg it on revenue, that the proportion of revenue. So you see them being coming out with a forecast like 0.05% of revenue, or of the total asset is to be disposed, you know. So, but in disposing assets, you have to get what the net book value of the assets you are disposing is. That will be the cost. Then what is the sales proceed you are going to receive from the sale? So you can see, since there is no ready market for you to get the disposal, the sales proceed to be earned from the sale of the asset, because this asset would be as good as scrap, you know. So placing value on scrap as a modeler for you to actually determine the sales proceed that will be recoverable from the sale is actually very the likelihood of forecasting such is very, very, very low, you know. So getting the sales proceed, getting the net book value, then subtracting that to get gain or loss on disposal. That's how that is done. Okay, then I continue to do a search. We've also got sales proceed. So you can see this is the sales proceed that is received from the sale of the disposed assets. So that's the figure there. And we'll move on. This is the purchases done during the year. So you can see 21,076,915. So we get to see that figure later on, and this is the acquisition for PPE and right of use assets. Continue to do that. We are going to note 15A. Note 15A. So this discussed about the IFRS implication of treating property, plant, and equipment, the recognition and measurement, So I'll just read a brief of it. Item of PPE are measured at cost less accumulated depreciation and accumulated impairment loss, and that's why the net is called the carrying amount. Okay, the cost of certain item of property, plant, equipment at 1st January 2011, the company's date of transition to IFRS, was determined with reference to its fair value at that day. So fair value is the market value of those assets at the date of transiting to IFRS. Okay, costs include expenditure that is directly attributable to the acquisition of the assets. Items of property, plant, equipment under construction are disclosed as capital work in progress. So that is noted. The cost of construction recognized includes the cost of materials and labor and any other costs directly attributed to bringing the asset to working condition for their intended use. So to bring the asset to a working condition might be installation costs, might be you paying transport costs, custom duties, and all of that. So those are costs that will actually bring the asset to a working condition for their intended use. Cost of dismantling and removing the item and restoring the site on which they are located, and borrowing cost of qualifying assets. So also borrowing costs for assets under constructions are capitalized. When the assets are fully constructed and put into operations, that's when the borrowing cost, the interest charges, are being expensed. Okay, so we also have purchase software that is integrated into the functionality of the related equipment. is capitalized as part of the equipment, because without the software in the equipment cannot perform its intended use. So that's why it's capitalized. Okay, when parts of an item or PPE have different useful life, they are accounted for as separate item. So they have separate useful life, so they are accounted for as a separate item. Major component of PPE. Okay, so that's it. Then gain or loss on disposal of an item of PPE are determined by comparing the proceeds from the disposal with the carrying amount of the PPE. So the carrying amount is just like the net book value and are recognized in the profit and loss account. That has been said. So subsequent cost for PPE, the cost of replacing a part of an item of PPE, is recognized in the carrying amount so of the item. If a major part of an equipment is replaced, that amount is capitalized, not expensed. So if it is probable that future economic benefit embodied within the parts will flow to the entity, to the company, and its cost can be measured reliably, the carrying amount of the replaced part is derecognized. The cost of the day-to-day servicing of the property, plant and equipment are recognized in profit and loss accounts. Okay, so then depreciation. Depreciation is calculated over the depreciable amount, which is the cost of asset and other amounts substituted for cost, less its residual value. So that's that about, and this is the useful life of each of the asset category that the company has, building 25 to 35 years, like that. And that's what we brought into our model here. So if you look at the model, let's go to our inputs. So our input, balance sheet, tangible assets. So useful life, I'm trying to get where the useful, okay, so these are the useful life. 30, so for building 25 to 35 years. So we did an average of the two, which is 25 plus 35 will give you 60. So 60 divided by 2 will give you 30 years. So you can either use the lower band, which is 25, or you use the higher band, 35, or use the average. So the second one is 18 and like that. So using the average of each of these years, except for motor vehicle that has it fixed at that. So that's how we actually got the useful life of these assets. Don't forget, capital work in progress is not depreciated. So we don't have the depreciation amount for capital work in progress here. Okay. And for capital work in progress, when the construction is finished, it is then reallocated to each of the categories where it belongs. If the construction work done is for land, is for PPE, is for motor vehicle, it is then reshared to each of the other asset heads. Okay, so I'll continue to move to do so that we'll go to note 15A and 15B, and I'll quickly show us how. So this is loss, this is depreciation, just like we have seen. Then we see property, plant and equipment here. So this is the note 15A, reconciliation of carrying amount. So here you see the asset categories as the heading, then the cost for 2020 and 2021. So we are concerned with 2021. So the additions of 2021 is 28,927, But before we go to the addition, we need to look at the net book value, which is the carrying amount as at 2021. So it's 98,964,157, which is what we have up here. Which is what we have here, 98,967,157. So this figure needs to tally, and the breakdown of all this is this. So the breakdown by each of the asset category. So you can see is this. And how did we get that? It's just by copying 25, 42, 22.4, 3.7, 408, into this place, and that's how we got all this. So I hope that is clear. That's how we got the net book value or the carrying amount of the company as at that date. Another part that we extracted here is the additions. Additions in 2021. I'm talking about the cost additions. So you go to under cost, the additions for 2021. This is the addition for 2020, or for 2021 is this. So I come here, it's total 2892,707, and so you see it somewhere here, the additions, which is new assets that was purchased during that period, is 2892,707. Okay, so this is the breakdown. So you can see the breakdown along the rows, 587, 2.2, like that. So you see that, and also the reason why you are not seeing the 587 and 2.2 is because this amount of capital work in progress. So if you get up, you see that this capital work in progress was reshared to other parts, other categories of assets, you know. So so it is now deducted from here. So this will then be added to the additions during the year, this reclassification, so that it can then be depreciated. So that's what we did there, and that's why if you had 1.7 and 587 together, you are going to get the 2 point something here that will go to 0.3, and the next one will go to 11.58. So meaning that if you had 2.2 and 9 million together, you are going to get 11 million. So that's how that was derived. I've shown you how we derive the useful life for new assets. Okay, any other thing I need to show you? Yeah, so for the existing assets, yes, we've told you that this is net book value, but this is the cost of those assets. So how did I derive that from here? So if you go to the under cost, you see 2021, the balance of 2021, which is the existing asset cost value, is 167,672,176. 167,672,176. And so getting them for each class of asset, land and building, is 36, 86, like that. So we've got 36, 86. So this is the cost, this is the net book value, meaning that the difference between the cost and the net book value has been depreciated already. So the amount remaining to be depreciated is this net book value, which we as modelers were concerned of. Going into the forecast period, we need to depreciate this value further. So this is the current depreciation amount that is charged in the P&L, amounting to 7,965,131. Adding that the depreciation of right of use assets was what made it to be 8 million here, the 8 million here. So if you had the right of use depreciation to it, you get the 8 million. But that of PPE only will give you 7 million, will give you 7.965. All right, so this is the depreciation that is charged. So in order to get the remaining useful life on this asset, so what you just need to do is to apply the depreciation amount over the net book value amount. So you then get what the depreciation rate will be, and if you take 100 and divide it by the depreciation rates, you'll be able to get the useful life of the assets. When you do, let me remove this so that you see the formula properly. So, or you can look at it in the formula bar. So multiplying with 100 is just to remove percentage from this division and divide on 100. I mean, use take 100 and divide by the result of this value. Then if it is 0, I use if error to, if it gives an error, it should show 0 instead of an error. So that's all that I did there. And so and the reason why I use if error is because of this last one that is giving will give an error, because we don't depreciate capital work in progress. All right, so that's how we got this. So the most useful figure to us really is the net book value and the remaining useful life, meaning that this 25 million will continue to be depreciated for 28 years, 28.2 years, and 42 will still continue to be depreciated for 8 years, So that's how this is established for existing assets. You need to get the net book value, take the annual depreciation, divide it by the net book value to get the depreciation amount, then turn the depreciation to useful lives, So by taking 100 and divide by the result of the depreciation percentage. All right. So that's how that is done, and you have also seen how. So for the capex, I show you how we extracted the capex, the useful life, how we are using the company standard useful life in their in the note to the account. So that's how we got all this. That's how we got all this. So you need to establish all of this. I delete all this. So in order for you to forecast what the new additions is going to be going forward, you need to get the proportion on revenue. So it's a capex. Capex is a percentage of revenue. So we brought our revenue here, which is the revenue for 2021, and we want to get the proportion of this. So this capex for land and building, this new addition in 2021 divided by the revenue of 2021, so that you get this proportion of 0.66%. So if you want to add any land and building going forward, we'll use this proportion. Now, you can as well try to get the proportion for other years as well, then take the average of those years, But I just want to keep it simple, and that's why I've taken just 2021, applied it on 2021 revenue to get this proportion. So this proportion is what we are going to apply to get our capex in 2022. We are going to apply this 0.66 on the revenue of 2022. So that's how it works on 2022 revenue. All right, so there is need for you to establish this capex basis of determining capex going forward, which is a percentage of revenue. So I guess that is clear. Like I told you for disposal, so this is the cost of disposal that has been done, and I've extracted that. So if you look at under costs, let's go to 2021. Under costs, you can see addition. Disposal is 1.98. So if you go to the model, you see 1.98 here. These are all the disposals done. Then accumulated depreciation, in order for you to get the net book value, you also go to the accumulated depreciation segment. 2021 disposal, you see 754,962. So 754,962. Now, so for you to get the remaining net book value, you just have to subtract the cost from the accumulated depreciation, and you get that this is the net book value. So the sales proceed that was received in 2021 was this. So take for instance, this is how much we sold these assets. So meaning that the sales minus the cost, which is the net book value, was giving us a loss, and that's how they got this loss on disposal of property, plant and equipment of 245,042. I guess this is an approximation error, but that's how that is determined. So like I said, if you look at the loss in 2020, you can see 73, and in 2021 we have 245. So really, this look at the sales proceeds in 2020 as well, 136 and 98. So really, you cannot actually lay a concrete a trend on this, and that is why I leave it out of my forecasting. I do not really forecast it going forward. So this is assumed that uh, we do not sell our property under under this. So I'm going to delete this. I'm going to delete that, and I'm going to state my assumption. No, it is assumed that no disposal will take place in the future. So that is clear on our assumption page. So I hope with these few words of mine, you now understand how to actually establish assumptions for let me bring this let me bring them closer, maybe somewhere here. So those are the two things you establish for property, plant and equipment. The remaining useful life, which is derived from the annual depreciation over the net book value, so that you know how many years you can depreciate this net book value further. Okay, then the new assets, you have the additions in 2021. So I'm going to put this as capex 2021. Oh, sorry. So 2021 capex, and so we have, this is the company standard useful life standard of the company. So let's wrap that. Okay. Okay, so that is that about this. We'll see you in the next video. So like I said, all this, it's I'm going to delete that. We don't need this. We have taken our assumption as not taking place in the future. All right, so see you in the next video.